Our credit outlooks offer in-depth insight into credit in 2019 and beyond. I'm Tony Stringer, Chief Operating Officer of Fitch's Sovereigns Group, and I'll be discussing what's on the horizon for ESG over the next 12 months. Joining me is Andrew Steele, Global Head of Sustainable Finance. So Andrew, what are your overall expectations for ESG in 2019?
Well, I think it's fair to say that we expect the relevance of ESG for investors to continue to increase throughout 2019. We also expect there to be further developments in the taxonomy and classification system surrounding ESG. And we're hoping to see quite a bit more transparency in the way that environmental, social and governance factors are explained to the markets. And we're also looking to take a lead in that role.
And what is Fitch doing to provide transparency around ESG and its role in our credit ratings?
In Q1 2019, we'll be launching a major transparency initiative to better articulate and display exactly which environmental, social and governance factors our analysts consider to be relevant to our fundamental credit analysis on a sector-by-sector basis. We'll provide a detailed breakdown at an entity level of just how material each of the sector-specific E, S and G factors identified by our analysts were to the credit rating decision that was made. Were any of the factors key rating drivers for the entity? Did the E, S or G sector-specific factor, when combined with other issues, help to drive the rating decision? Was the entity managing certain ESG factors in a way which meant that despite their credit relevance for the sector, they didn't impact the rating decision for the entity? We've been busy empowering our analysts to discuss this type of detail with investors in the context of the overall credit decision that they're making.
And finally, how is Fitch's analytical approach to ESG unique?
In response to investors' demands for better clarity and more detail on ESG factors over the last few years, the major credit rating agencies, including ourselves, have reiterated that if a factor was material to the credit analysis, it was included in our research. We all provided some overarching research and backtesting to show instances where factors have been relevant, but this was neither comprehensive nor current. Investors were left in a position where they were not able to identify easily which ESG factors were relevant to a CRA at a sector-specific level, and beyond those having an obvious short-term impact on the rating, investors were unable to work out how material for a credit rating agency the factors were at a specific entity level. With the launch of our entity-specific ESG relevance scores, our entity-specific research will clearly display for investors the level of relevance and materiality of environment, social and governance factors to our analysts' credit rating decisions. Investors will be able to discuss ESG factors with each of our analysts in the context of their overall credit decision and will be able to make detailed and informed judgments about whether they agree or disagree with this aspect of our ratings analysis. In one sense, it's very much what we've always done, provide independent, insightful analysis from a fundamental credit perspective. But it is unique in providing a sector-specific fundamental credit view of ESG across all our ratings groups, and in providing detail about the relevance and materiality of this to the credit decisions of individual entities. I can't really stress enough that it's a credit-focused fundamental analysis of relevance and materiality, which we believe is a step change in the level of transparency for ESG and ratings. In this respect, it is unique, and we very much look forward to sharing it with the market.
Andrew, thank you very much for your insights, and thank you for watching. For all our 2019 Outlook reports, please visit our website.